China's government is acting quickly to pull the country back from the brink of a crisis. In a highly anticipated news conference yesterday, the country's finance minister promised to significantly increase debt to revive its economy, but left investors guessing on the overall size of the stimulus package.
The Asian tiger's economy had been slowly declining over the past 4 years, triggered by the bursting of a hot property bubble. We're going to get into that now and how it's affecting the Australian economy with Shane Oliver, Chief Economist with AMP. Thank you so much, Shane, for taking the time to speak with us on this Sunday morning.
My pleasure, thank you.
Right, now we had seen 2 major property developers defaulting in 2020 in China. I wonder whether that was the first sign of trouble.
Look, I think, to be honest with you, the trouble had been brewing for some time. We've been looking at a long-term downtrend in property prices in China. There's long been debate about ghost cities and an oversupply of property, but those problems first came to the headlines, I guess, with those property developer failures. But it's still ongoing. You know, we're still seeing property price declines in China. There's still an oversupply of the sort of property that they've been supplying. And I guess it also comes at a time when China has many other structural problems, most notably the decline in the size of its workforce and the fact that the Chinese consumers, Chinese households save too much because they have to cover things like education costs and, of course, retirement costs. So they don't have the social security network and the confidence that Australian consumers do to go out and spend.
I want to get into the structure of the economy in just a moment, but, you know, we have seen China have this economic growth for years and years and years now. Surely this decline would have been predicted at some point. Why then did Beijing not act sooner?
Well, that's true. All countries go through a rapid industrialisation phase once they develop. Many Asian countries went through that, and then you see a bit of a slowdown. I guess China's slowdown has perhaps been more acute and faster than many had expected. The Chinese government, I think, has been relatively slow in responding because it fears that if it goes down the path of Western countries, such as stimulating consumer spending, then it thinks that's the wrong way to go, that it's just a sign of decadence when you've got to stimulate consumer spending like Western countries did through the GFC and also through the pandemic. So a lot of the response in China has been focused on ramping up in infrastructure spending, investment generally. But of course, that just leads to issues of oversupply and doesn't really address the underlying problem, which is lack of consumer spending.
Of course, and well, that's one issue, but also how, you know, with this emergency stimulus measures, how long can Beijing keep injecting funds into the economy to keep it afloat?
Well, that's a good question. Right now, Chinese debt problems have increased substantially, but they're not at a point where they've become a major constraint because China saves a lot, it borrows from itself. So it's not like many other developing countries, say in South America, that run into trouble by borrowing from other countries. So in that sense, it can go for a while yet, but it does have to address these structural problems. So in the short term, it's got a cyclical problem. Growth has slowed down, looking quite weak. That's why the authorities have moved, most notably with the announcement yesterday, but obviously there's more to go. So they will provide a cyclical boost, but they need to address these structural problems, and that's the big unknown in all of this. If we just get a cyclical boost, like a sugar hit, the economy picks up for a while and then starts to subside again.
Okay, so where does this leave Australia? You know, especially after the Federal Treasurer Jim Chalmers returned from Beijing, seemingly buoyed by this announcement of this Chinese stimulus into their own economy.
Well, I guess Australia's sort of managed to come through this period of slower Chinese growth sort of okay. And we saw back in 2020 when something like 8 major export items were subject to constraints going into China. Of course, the one on lobsters has been removed recently. That was one of the smallest ones, but also coal, copper, meat and so on. But we seem to come through that okay. We're able to divert our exports to other countries. So providing China doesn't sort of fall off a cliff and go into a deep recession, then I think Australia will be able to adjust. One of the big areas where there is a sensitivity is in terms of the iron ore price. Up until a few weeks ago, the iron ore price was sliding. That obviously has a budgetary impact in Australia because Australian mining companies make less profits. That means less revenue going to Canberra. So that was a bit of a concern. So understandably, the Treasurer has been buoyed by that stimulus because it's pushed the iron ore price back up again. And so that provides a bit of ongoing source of revenue surprise potentially for the Australian government. So right here, right now, it's not a major threat to Australia. We seem to be handling it okay. And of course, if that stimulus comes through, then it will protect the iron ore price.
Shane, China's markets and the economy are mainly policy driven and driven by Xi Jinping, the president, rather than profits driven. But do you see this changing anytime soon, perhaps with the Chinese government relinquishing some control?
Well, in an ideal world, that's what you'd want to see. China did very, very well through the industrialisation phase, much like the Soviet Union did in the 1930s. But it gets a lot harder from here. You are relying on entrepreneurial spirit, innovation, and that's going to be a lot harder in an environment where the Chinese government under Xi Jinping is exercising so much control. Those animal spirits of innovation are likely to become dimmed. And that is, I think, a longer-term structural concern about China, that its growth will slow down over time, not just because of slower workforce growth, but because of less entrepreneurial activity as the Chinese government exercises more authority. And unfortunately, when you see that, it makes it a lot harder for economic growth to occur. Investment will start to slow down. A lot of the focus is increasingly on state-owned enterprises, but they're known to be less productive. So this increased government control in China, you'd have to say, is a longer-term concern for the dynamism of China and for its long-term growth potential.
Right, Shane Oliver, Chief Economist from AMP, we thank you so much for joining us this morning.
My pleasure, thank you.